Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today we're asking, stagflation is here, the Fed has no way out versus the stagflation panic is your buying signal. Let's hear from the hawk and the contrarian.
Oil at $99.64. The 10-year Treasury at 4.42%. February payrolls at negative 92,000.
Wall Street has discovered stagflation. Goldman puts recession at 30%. JP Morgan says 35%.
The parallels are uncomfortable. An external energy shock driving costs higher while domestic demand weakens. A central bank behind the curve.
The 1970s comparison is lazy analysis. The U.S. economy in 1973 consumed 46 barrels of oil per $1 million of GDP.
Powell pointed to 4.4% unemployment as proof the economy is fine. But the February jobs report told a different story, negative 92,000 payrolls, the worst print in 4 months and a massive miss against the 59,000 consensus estimate. ADP's private sector reading was barely positive at 63,000.
Here's what the bears conveniently ignore. The Fed funds rate sits at 3.64%. That's 125 plus basis points above the pre-pandemic neutral rate estimate. The Fed has room to cut without abandoning its inflation mandate.
The 2s10s spread has widened to plus 46 basis points, a classic bear steepening pattern. Short-end rates are anchored by rate cut expectations, the 2-year at 3.96%, while the long-end climbs on inflation fears, the 10-year at 4.42%, the 30-year at 4.93%. Chart line Treasury yield curve bear steepening, labels frowny face MAR 11, MAR 13, MAR 17, MAR 19, MAR 23, MAR 25, MAR 26, datasets frowny face, label :10Y yield, percent, data frowny face 4.21, 4.28, 4.20, 4.25, 4.34, 4.33, 4.42, comma. Label :2Y yield, percent, data frowny face 3.64, 3.73, 3.68, 3.79, 3.83, 3.84, 3.96, comma, label :30Y yield, percent, data frowny face 4.86, 4.90, 4.85, 4.83, 4.91, 4.89, 4.93. This is the bond market pricing in exactly the scenario Powell denied, inflation that doesn't come down while growth stalls.
Since 1990, buying the S&P 500 when the VIX exceeds 30 and holding for 12 months has produced positive returns 88% of the time, with a median gain of 22%. The VIX hit 31.05 on Friday. The signal is clear.
Cut rates and oil-driven inflation becomes entrenched. Hold rates and the labor market deteriorates further. Raise rates and trigger the recession. Goldman is already pricing at 30%.
Quarter 4 2025 GDP came in at $31.4 trillion annualized. The economy is still growing. Corporate earnings season showed broad-based strength. Revenue growth remained positive across most sectors.
Powell can call it whatever he wants. Oil near $100, negative payrolls, yield steepening, and the VIX above 30, that's stagflation by any name.
Every recession scare of the past 5 years has been a buying opportunity for investors who didn't panic. The COVID crash, the 2022 rate hike cycle, the 2025 carry trade unwind, the tariff escalation, all produced temporary drawdowns followed by new highs. Two very different takes. The hawk and the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.